Hello guys, I hope so you will be fine. So today we are going to talk about a third unit. This unit belongs to financial statement analysis. This is one of the CMA Part 2 domain, which is 20% of your exam. So unit 1 and unit 2, which is about liquidity, solvency and leverage ratios, profitability and per share ratios. These two units have already been uploaded. The third units I'm going to discuss today, which is activity ratios and earning quality. So in this unit, guys, we have actually two topics. The topic number 3.1 is about activities ratios, in which we will discuss some ratios about receivables, inventory, and payables. And then we got 3.2. This topic is relevant to ratio analysis and earning quality. So here we go. 3.1. Mainly today, I'll focus on receivables ratios. So guys, first we need to understand what does mean by activity ratios. So guys, activity ratios measures how quickly two major non-cash assets. We got two non-cash assets like account receivables and inventory. How quickly we can convert these non-cash assets into cash. Okay, so this is what is activities ratio. And please remember here, when we calculate any activity ratios, we need data from income statement also and from statement of financial position, which is balance sheet. So we need data from both financial statements. So here we have a just a basic recap of our balance sheet. Let's assume in your exam question, definitely if you are required to calculate certain ratios, so data will be provided. So you need to know how to apply those formulas. Formulas I'll explain, but before moving to the formulas, I just want to explain quickly the balance sheet. Here we got a balance sheet. In balance sheet, we got resources side, it means asset sides, and financing side means your liabilities and equity side. So guys, here we got our 2 years data for the current year and for the prior year. Same for asset side, and similar data we have for financing side, I mean to say liabilities and equity side, current year data and prior year data. So under current assets, we got here first cash and equivalents. This is the figure for current year. This is the figure for the prior year. Then we got here available for sale securities for current year, for the prior year. Then we got here account receivables, net figure. Net figure, it's about gross receivables minus allowances. So that's called a net figure. So we got here for the current year and for the last year. Then we got note receivable for current year and for the last year. We got inventories for the current year, and for the last year we got prepaid expenses as well. So then we got it here, total current assets, which is 760,000 for current year and 635,000 for the prior year. And then we got it here, non-current asset section. Under non-current asset section, we got equity method investments for current year and last year. We got PPE, property, plant and equipment for current year and for last year. And we got it here, accumulated depreciation also for current year and last year. We got goodwill, which is intangible assets, current year and for the last year. And total non-current assets, these are the figures for non-current assets. And on other side, we got here liability side. First we have here current liabilities. We got accounts payable, notes payable, accrued interest on note payable, you can say current maturities of long-term debt. So this also your current liabilities, accrued salaries and wages, income tax payables. So here we got total liabilities for current year and for the last year. Then we got it here non-current liabilities, in which we have bonds payable, long-term notes payable, employees related obligations, deferred income taxes. So we got it here total non-current liabilities for current and total non-current liabilities for non-current. And here we got it here total liabilities. Total liabilities means which includes current plus non-current. Again, for the prior year, current plus non-current equals total liabilities. Then guys, we got it here stockholders. equity, like equity section, we got it here preferred stock with par value. In the current year, we have nothing in the prior period. Then we got common stock at $1 par, which is current and prior year's figures. We got additional paid in capital. Okay, we got retained earnings for current year, and for the last year here we got total stockholders equity. So if you will add this liabilities plus equity, so this is going to be your total liabilities and stockholders equity. So again, we got here total liabilities plus equity. We got it here total liabilities and stockholders equity. And we know asset side should be equal to liabilities plus equity. Okay. Then we got it here, guys. Income statement also, because why I'm going through this these financial statement, because the data from these financial statements we will use with the examples, and then we will perform some couple of exam standard question at the end of session. So here we got an income statement. So this is again current year data, prior year data. So we got net sales figure. Okay, then we got less cost of goods sold equals gross profit. Then we got selling, general and administrative expenses for current years, prior years. This is your operating income. Okay, operating income, you have idea that this is the income which we got after the deduction of your routine operational expenses. And then we got it here other revenues and losses. Okay, other revenues and losses, definitely these are presented after your operating income. So we should know what is the meaning of other revenues and losses. So please remember, guys, there are actually uh, other revenues and losses. These are actually non-operating items. Okay, meaning they are not related to the company's core business activities. That's why it's called other revenues and losses. Okay, like selling products or services, but still impact the net income. So as I told you, these are not related to the company's core business activities. So what are the examples for other revenues? First, I'm giving examples like what could be the part of other revenues. It might include some interest income earned from bank deposit or investments. It might include dividend income also. It might include gain on sale of assets. Example, selling land or equipment above book value. So if you got a gain, so that could be the part of other revenues. You might have a rental income if renting is not the core business, foreign exchange gains, etc. And now the question is, what could be the part of other losses? So other losses might include interest expense, but here interest expense is written separately. But apart from interest expense, it might include loss on sale of assets. Example, selling an assets for less than book value. So it is your loss that might be here. Lawsuit settlement expenses. It might include foreign exchange losses. Sometime impairment losses also. Impairment losses, writing down assets value, right? So then we got it here earning before interest and tax. Okay, this is the figure for current year, this is the figure for last year. Then we got here minus interest expense. Okay, then this is called earning before taxes, then minus tax, which is 40% in my example. So this is equals your net income. So these are two financial statements. We got a data from these two financial statements here. Now, guys, I'm moving to the main ratio. And please don't forget, we are talking about activity ratios. And activity ratios is all about how quickly non-cash assets we can convert into cash. That's what is activity ratios. So here we go. We are starting with first account receivables. Okay, account receivables, like ratios are related to the account receivables. So here we got actually two ratios which belongs to account receivable. One is called turnover ratio and second is called collection period, average collection period. Okay. So average collection period is also called days sales outstanding in receivable. So DS, so shortcut. Okay, that I'll show you, don't worry. So now the question is that what does mean by these two ratios, turnover and average collection period? Actually, turnover ratio will give you answer in times, and average collection period will give you answer in days or months. Okay, now the question is, what does mean by turnover? Turnover simply, it measures the efficiency of account receivable collection. So what it means? It means turnover implies that how many times we converted our receivables into a cash in a given period. For example, if given period is 12 months. Okay, let's assume. So the period is 12 months, I mean, so 1 year. In 1 year, for example, the ratio answer is 7 times. It means in 1 year period, 7 times we converted our receivables into cash. So that's called turnover. But when we talk about average collection period, actually it will give you answer in days. So what it means? It means on average, how many days customers are taking to pay our debt. Okay, so or to settle their account. So that's called collection period. So these are two separate questions. Turnover is separate and average correction period is separate. Okay, now I'm starting with first the account receivable turnover. So if you look at here, what's the interpretation which is written here? Account receivable turnover, which will give you answer in times, measures the efficiency of account receivable collection. As I told you earlier, it means how many times we converted our receivables into cash in a given period. Definitely higher answer is desirable, not the lower answer. Okay. And the question now, the second question is how this turnover ratio is calculated, which is called account receivable turnover ratio. How it is calculated? For that, we always need in the numerator net credit sales. Okay. Net credit sales, guys, please remember in your exam question, you might be given with cash sale and credit sales. So you make sure you are using here credit sales. Another scenario, if sometime in your exam question only net sale is given, net sales is given and there is no breakup for cash sales or credit sales, then we will assume this net sale is equal to your credit sales. Okay, so we will take net credit sales divided by average account receivables. Now the question is that how average account receivable is calculated. So it's very simple. You know, I think so. You should know this. Average account receivable is always calculated by taking beginning account receivables. It means the amount of receivables which we had at the start of the period plus ending account receivables means the amount of receivable which we are having at the end of the year. We will add these two figures and we will divide it with the two. This is called what? Average account receivables. Okay, so this average account receivables we will divide it here. So net credit sales divided by average account receivables. So this is called your receivable turnover ratio. Okay, it will give you answer in times as I told you earlier. Okay, now the question is, this is also really important point. Sometime we might have seasonal business. Okay, so like if a business is highly seasonal, what it means that seasonal means that sometime in season your receivable balance goes up, sometime your out of season your receivable balance goes down. It's zigzag in a year, so seasonal effect is there. So in that scenario, so we are not required to calculate average of beginning of receivables at the start of year and ending receivables at the end of the year. No. So in that scenario, monthly balances should be averaged. Monthly balances if your business is seasonal. So what does mean by monthly balances? Monthly balances, this is how you can calculate. For example, in your exam, he may tell you that your business is seasonal and you have account receivables at the end of month of January, February, March, April, May, June, July, August, September, October, November, December. So he gave you all 12 figures of every month figure. Okay, by the end of each month all 12 figures are given. So then what you will do, you will add all receivables, for example account receivables of January plus account receivables of February, March, and so on up until December, and then you will divide with the 12, not with the 2, because here you are going to get the average of 12 figures. So that's why you are dividing with 12. And here if you are taking average on annual basis, so then you are using only two figures, beginning account receivables which we had at the start of year and ending account receivables which we have at the end of the year, because these are two figures. So that's why to get the average we always divide with the two. Okay, so I hope so you understood that with monthly or seasonal effect, so monthly balances should be averaged instead of annual. So now we got it here, account receivable turnover ratio. How it is calculated, let me just tell you here. For example, if you want to, this is the data, the numerator is what? if you are calculating turnover ratio for receivables, turnover ratio. I'm just using for the current year first. So you need a credit sales. Okay, net credit sales. So this is the current year, and credit sales definitely you will get from the income statement, right? So this is the current year sales. You will take this figure. So 1.8 million. Okay, because there is no figure for credit sales, but it's given as a net sale, so I'm assuming it's a credit sales. Otherwise, if in your exam cash sale or credit sale is given separately, so you should use here credit sale only. I'll show you with the help of question also, don't worry. So we are assuming this net sale is equal to credit sales, and now we need to divide with the average receivables, and receivables figure definitely you will get from the balance sheet. Go to the balance sheet in current assets. These are the current assets. Okay, this is the opening figure. This is the receivables net. This is the opening figure, which is 115,000, and this is the closing figure. We will add these two figure and we will divide with the two. Okay, so opening and closing. So opening figure was how much? 115,000 plus closing figure is 120,000 and divided by 2. Okay, so this will give you average. And if you will solve this credit sales divided by average figure, whatever answer you will get, so this will give you answer in times, and this answer is going to be how much? 15.3 times. Okay, now, the question is that what does mean by this 15.3 times? I already told you. It means in the current year, we converted our receivables into cash by 15.3 times. Okay. Now, if you want to calculate for the prior year, again, for the prior year, you need these two figures. What? Turnover for the prior period. Okay. So you need net credit sales. So net credit sales for the prior year, net sale is available, which is 1.4 million. We can take this figure. 1.4 million. Now the question is that we need to get the average. To get the average, we need opening figure plus closing receivables divided by 2. Okay, now the question is that closing we have here. Closing figure for the prior period we have receivable how much? 115,000. Okay, what about opening? So closing we got 115,000. I'm just putting here plus 115,000. What about opening? Because opening we need figure here and it's not given in the question. So here that's why it is assumed in the solution that opening figure for the prior year is 105,000. So now you will divide with the two, this will give you average. So this average you will divide with the credit sales, so you will get the answer, and your answer is going to be 12.7 times. So you can look at your formula as written. This is total sales, net sales, divide by closing receivables plus opening receivables divided by 2. Okay, so this is your 12.7 times. Okay. Okay, now guys, here if you look at here, your answer has improved or not? Yes, because in prior period you were converting your receivables 12.7 times into cash, but this year it has increased to 15.3 times, which is a good sign. Now another thing, sometime they may ask you the reasons, okay, that why turnover ratios could be higher or lower. So let me take you to the formula and I can explain quickly from here. Then I'll take you to the theoretical side of this discussion. Okay. Guys, look at here. Turnover ratio, if you want higher answer, so there are two ways to get it higher answer. The first thing is, if your net credit sales will increase, definitely it will increase your turnover answer. Or if your average balance of receivable will decrease, again your turnover answer will increase. So that are the two reasons for the high turnover ratio. Either your net credit sales should increase without changes in account receivables, or your net, at least your average account receivable balance should decrease. So then what will happen? Your turnover ratio will be lower. You can reverse this scenario. If you want lower turnover, then you have to reverse. Either your net credit sales should decrease or your receivable balance should increase. So you can reverse it. Okay. So here it's explained here. High turnover. High turnover, as I told you, the formula is net credit sales divided by average account receivables. If you want high turnover, either your net credit sales should increase or your average account receivable should decrease. So these 2 points are explained here. So a higher turnover ratio implies that, first they are trying to explain the meaning. High turnover ratio implies that customers may be paying their accounts promptly. Okay, because turnover is high means say we are converting receivables more times into cash, so it means they are paying promptly. Okay, what could be the reason? Because the first reason could be the sales are the numerator. Definitely sale is the numerator in the formula. Higher sales, as I told you, if sales will increase, it will increase your turnover. Higher sales without an increase in receivables. Okay, if your sale will increase without changes in receivables, definitely it would result in higher turnover. These points are required to solve theoretical question. Second point, now the focus is on average balance of receivables, because receivables are the denominator in the formula. Yes, encouraging customers to pay quickly. Definitely, if customers will pay quickly, so automatically average receivable balance will go down automatically. Okay, uh, they are saying encouraging the customers to pay quickly, thereby lowering the balance in receivable. Yes, true, also result in a higher turnover ratio. Okay, now guys, sometime turnover ratio answers could be lower. And if answer is lower, these are two possible reasons. Number one, even your if your net credit sale is decreasing, or if your average account receivable balance is increasing, right? Now this is the point here. This point is explained here. The lower turnover implies that customers are taking longer to pay. First, it's a straightaway interpretation that if turnover ratio answer is lower, it means customers are taking more time to pay. And the question is that how turnover could be lower. I told you either if your net credit sale is decreasing or if your average account receivable balance is increasing. If due to this your turnover ratio answer could be lower. Now this point is explained here. So they're saying if discount period is extended, sometimes we give cash discount, early settlement discount to the customers. Oh, okay, if they will pay cash within 10 days, so they will get 2% discount. If you will extend this discount period from 10 days, let's assume to 30 days. Let's assume you are saying that now your credit term is normal credit period is 90 days, but if customer will pay within 30 days, they will get a discount. It means you are extending the discount period. So if the discount period is extended, the customer will be able to wait longer to pay, which will increase the average balance of receivable and which will decrease your turnover ratio. I hope so it is clear, right? This is the first ratio. Now I'm going to explain the second ratio related to the receivables. Then I'll show you some couple of questions. You can see how the questions can be tested in your exam. So now guys, here we got a second ratio, which is days sales outstanding in receivables. As I told you, it is also called average collection period. Okay, or it's also simple words, it's also called receivable days. Okay, so what it measures? It measures the average number of days it takes to collect our receivables. In other words, how long customers are taking on average to settle their debt. Maybe they are taking 15 days, 30 days, or 50 days. Here, please remember, lower answer is desirable, because as a seller, as a company, I want my customers to pay early, not later, right? So that's why lower answer is desirable here, not the higher. So the question is how you will calculate this average collection period. This average collection period is also called days sales outstanding in receivables. Okay. So what's the formula? There are two formulas to calculate the average collection period or days sales outstanding in receivables. The first formula is which is based on turnover. The first formula is what you have to take days in a year. It could be a 365 days or 360 days, whatever given in the question, use that one. Okay. Divided by account receivable turnover. Actually, this numerator is the answer of first ratio, which we have learned. Answer of first ratio. Okay, so we have just calculated turnover ratio here, right? So turnover ratio we calculated here by using this formula net credit sales divided by average account receivables. The answer of this ratio is turnover, and that turnover, if you will divide here with the days in a year divided by account receivable turnover, this will give you average collection period in days. That generally, for example, if answer is 40 days, it means customers are taking 40 days to settle their debt. Okay. Now, now there is another alternative formula to calculate the average collection period, and that formula is written here. So what's the formula? A day sales outstanding means the average collection period. You can calculate by using this formula also. Average account receivables. Average, I have already told you how you will calculate. You will take opening account receivables plus closing account receivables divided by 2. Okay, divided by, once you got this average account receivable as a numerator, then you have to divide with the total credit sales. Again, if total credit sales are not given specifically, then you have to use net sales as a total credit sales. Multiply by number of days. Definitely it could be 360 or 365 days in a year, whatever is given, just use there. So you will get answer here in days. So it means either you can use this formula or you can use this formula to calculate the average collection period. Okay, now make sure, guys, sometime in your exam question, he may give you other data. Now, just I'm telling you because he may confuse you to solve the questions or to find out the specific answer. So please remember, sometime in your exam, he will give you all the information. He will tell you day sales. Outstanding, he will tell you credit sales, he will tell you number of days in a year, and he will ask you to find out average account receivable figures. How would you calculate? So you have to rearrange this formula mathematically. Once you will rearrange, so the average account receivables will be equal to total credit sales divided by number of days in a year, number of days in a year, multiply by average collection period, because average collection period are days sales outstanding he will give you in the question. Total credit sales will be given, number of days will be given. If you will solve, you can get average account receivable balance also. Okay, I hope so it is clear. So now let's do some questions directly so you can get the idea here. For example, it's first a very basic and simple question. So here is only the one trick: cash sales and credit sales are given. So you have to use credit sales, make sure. So let's have a look. They're saying the year-end financial statements for Queen Bikes reflect the data presented as follow. So what's the data? The percent of Queen's net sales are in cash, 10% of Queen's net sales are in cash. It means whatever sale figure is provided, so 10% of that is the cash sales. It means 90% of that sale is your credit sale. So we got it here, net sales data. Year one, year two, year three. Here we got the net sales. We sold in year one 1500 units at 100 each. In year two, we sold 1200 units at 100 each. In year three, we sold 1200 units at 25 each. Okay. So then what? We got it here. Ending inventory for each year, 100 units at 50, 100 units at 50, 100 units at 50. Okay. We got average receivables. Okay, guys, you are not required to calculate average receivables. It is given. So 12,500 for year one, 12,000 for year two, 12,000, 14,400 for year three. Then we got it here, net income. Okay. For each year. Now the question is that Queen's receivables turnover you have to calculate ratio for the year 2 and the year 3. Okay, so here we go. Very simple. We know the turnover ratio formula is, turnover formula is what? Net credit sales divided by average account receivables. Okay, so because he's asking for year 2 and 3, so this is for year 2 and this is for year 3. Okay, so net credit sales for year 2, net credit sales, this is the net sales is given 1200 unit into 100 each multiplied by 90%. Why 90%? The reason, because 10% of the sale is a cash sale, he told you here. It means 90% is the credit sale. So first, net sale will be equal to, if you will just solve it on your calculator, so 1200 times 100, 120,000 times 90%, it is 108,000 as a numerator. And average balance receivable is given here for year two, 1,200 or 12,000. If you will solve 108 divided by 12, so answer is 9 times. Okay, this is for year two. Now do for year three also. This is your sale, 1,200 into 125 into 90% again. So this will be equal to into 125 into 90%. It will be 135,000 divided by, this is the average receivable is given 14,400. So answer is 9.375 times. So it means which is the correct answer. For year 2 it is 9 times, for year 3 is 9.375. So this is 9 times for year 2 and 9.375 for year 3 respectively. This is the correct answer. Okay. Now, guys, we got it here. Another question. What's the question here? They're saying that a company has a 3 million per year in credit sales. Okay. This is the credit sales. The company average days sales outstanding means average collection period is 40 days. Okay. Assuming that 360 days a year, he told you there are 360 days in a year. What's the company's average account receivables outstanding? He's asking about average account receivables. Do you remember I told you that when you calculate average collection period, what's the formula, which is also called days sales outstanding? The formula was average account receivable balance, average balance of account receivables divided by total credit sales, net credit sales, multiply by 360 days. So, but he's asking about account receivable, so we need to rearrange this formula. So, average balance of account receivables equals total credit sales divided by 360 multiplied by DSO, means say days sales outstanding in receivables or average collection period. So, total credit sale is given here 3 million divided by 360. It will give you, or definitely once you will divide 3 million, which is annual sale, divided by 360, so you will get per day sale, and simply multiply with the average collection period, which is 40 days given here, multiply by 40, so it will give you answer of 333,333. So 333,333. So this will be your answer, B answer. Okay. Okay, B will be the correct answer. Now we got another question. This question is actually your will test your concept. So please, bit a tricky question, even it's theory, but it's really important. So the question is what? The account receivables turnover ratio will normally decrease. You know the turnover ratio, how it was calculated? It was calculated in net credit sales divided by average account receivables. Okay, that's the formula for turnover. Now the question is why this turnover ratio will decrease, how it could decrease. Let's go to the reasons. I have already explained these reasons. If you will go back into the turnover ratio, and here it is explained, the lower turnover could be what? Lower turnover implies that customers are taking longer to pay. Yes. And the reason could be if the discount period is extended, definitely customer will be able to wait longer, which will increase the receivable figures, which will decrease the turnover. So go back. Okay. If you look at here, the formula is written here. The turnover ratio answer could be lower. Why? If your credit sale will decrease or if your account receivable balance will increase. So this reason I have already explained, that if you will extend the discount period, so which will increase your account receivable figures, which will decrease your turnover ratio. So this answer is written here. A change in credit policy to lengthen the period for the cash discount. Like if you are changing credit policy, which will extend the discount period, definitely your turnover period will decrease. So this is actually the answer. Now we need to understand why these three are not the answer. Now here we go. So number one, they're saying a write off an uncollectible account. Assume the use of allowance for credit loss method. Will it decrease the turnover? No. I'll tell you here. This actually requires the concept of accounting. You know, in accounting, we learned when we record our assets in balance sheet, especially receivables, we record gross receivables. I'm assuming $100 minus allowances for credit loss, or allowances for uncollectible account. I'm assuming it's $40. So this is called net receivables figure, which is 60. Okay, now the question is that when you write off uncollectible accounts, you know what entry we pass? We pass this entry always. We debit allowance for credit loss and we credit receivables. Let's assume amount is $10. So due to this, receivable is being credited by 10, so it means receivable will become 90 now. From 100, it is reduced by 10, so it will become 90. And with same amount, this allowance is also decreased from 40. It will be 30 now because it has reduced by 10. So if you look at here, your receivable figure is still 30. It means your receivable is not changing due to the writing of an uncollectible accounts. If receivables are not changing, your turnover ratio will remain unchanged. So this is not the answer. I hope so it is important and clear. Number two, a significant sales volume decreases near to the end of accounting period. Definitely, guys, when you decrease the sales, when sale is decreased, so definitely if you look into the numerator, that's the credit sale. Okay, credit sale. If they're saying if sale will decrease, so definitely receivable will also decrease, right? If sale is decreased, receivable will also decrease. So now, due to this, if the numerator and the denominator both has decreased with the same amount and your original answer was greater than 1, so then the turnover ratio will increase, not decrease. So I can just assume and explain again. Don't worry if you didn't get it. Here we got the explanation for that. So generally, when there is a decline in sales near to the end of the period, usually what it means, sale decrease means your credit sale is decreasing and your account receivable is also decreasing. Definitely due to credit sales, your receivables are rising. If credit sale has decreased, account receivable will also decrease. So if both the numerator and the denominator in the ratio, in the turnover ratio, the formula is net credit sales divided by average account receivables. Okay, that's the formula. So if let's assume first I'm assuming figure, let's assume our old before this decrease in sales, our net credit sale was 50 and accounts receivable was 25, so answer was 2 times, right? Let's assume. Now what? Now we are assuming that your net credit sale has decreased from 50 to 40, let's assume. And definitely, because numerator and denominator is decreasing by the same amount, so if you have reduced this from 50 to 40, so this should also be reduced from 25 to 15 by, because we are reducing by 10. Now so get the new answer. 40 divided by 15, definitely it is going to be, your answer is going to be 40 divided by 15. Your answer is going to be 2.67. See, turnover ratio has not decreased. Turnover ratio has increased from 2 times to 2.67 times. This is what it means. I have explained here. The decline in sale due to the end of period usually means credit sale will decrease, receivable will decrease. If the original ratio was greater than 1, yes, it was greater than 1. We just put the figures. So the both numerator and denominator in the ratio decreases by a similar amount. So the actually answer will increase. I have explained to you. So, but the question is about the decrease, not the increase. Okay, the question was about like why turnover ratio could decrease. Answer we already discussed. Now just I'm removing why these are not the option. Now see, an increase in cash sales in proportion to the credit sales. Definitely, cash sale has no effect on this turnover ratio. Okay, but he didn't tell you that credit sale is being decreased. They're saying increase in cash sale in proportion to the credit sales. Okay, in proportion to the credit sale. It means credit sale is also increasing, but cash sale has increased with the bigger proportion. So this would cause the increase in turnover ratio, not the decrease. So the question is about decrease. I hope so it is clear, guys. See you in the next video. Thank you so much. Bye bye.